This is a new venue for all of us, so I hope everything works. Normally we are in more pedestrian settings, perhaps more appropriate also for our endeavor at the India International Center. But series of circumstances have led us to this venue, which is also a very nice venue, of course. I'm going to request the curtains to be drawn, to be pulled, because we do need natural light to keep everybody awake. And more light is always better than less light. So my name is Shekhar Shah. Everybody knows who I am, I think. But anyway, we've been doing this workshop, seminar, conference for 15 years. It has an advisory panel and a research panel. The names are in the India Policy Forum volume that will be available and released tomorrow. We have a very full program, 3 papers today, a panel discussion on healthcare, and thereafter the India Policy Forum lecture by Professor Avinash Dikshit. And we are privileged to have all of you here. The order of the day is I'm going to just step off very quickly and request the panelists to come. We've had to switch the opening session to about 10:30 because Mr. Suresh Prabhu, Minister for Commerce and Industry, has had to be in attendance at the President's house in the morning at 9. So once he finishes his duties there, he's going to come here, and we're going to do his keynote remarks at 10:30 roughly. And thereafter he will have a cup of tea perhaps with us when we break for the tea at 11 o'clock. So we've just switched the two in the morning. And so without further ado, I want to just call the authors of the first paper on tax breaks and the impact on household saving, and also the discussants. So Renuka and Ila and Radhika, and please the discussants, Rajnish and Govinda Rao. Govinda, may I invite you to the table, and Arbind Modi, the chair. The rules of the game are 30 minutes for the authors, 10 minutes each for the discussants. That adds up to a good 50 minutes. And so we then have roughly 40 minutes, give or take, for floor discussion. The floor discussion really is an integral and important part of the India Policy Forum, because at some level this is like a big editorial board meeting. We have commission papers, and then we kind of pass it through the IPF, and they emerge generally brighter, shinier, and a lot more useful. So with that, again, Ila, aren't you going to join? Oh, okay, all right. Very good. Then let me hand over to Arbind, 30, 10, 10, and then the floor discussion. And please be merciless with everybody.
Thank you.
We call it the iron fist in the velvet glove. So I'd urge you to be as disciplined as you can be. Thank you.
Good morning, everybody. I wonder whether it's a good idea to start with tax as a first session in such a big conference. But anyway, Shekhar has chosen to do so, so I'll go by NCER's decision. Now, this topic of taxation of household financial savings, this discussion or this paper by Ila couldn't have been more timely. And when I say that, there are 2-3 reasons for that. One is that India is currently in the midst of rewriting its direct tax law. So the central to the design of the personal income tax is how we treat savings. So I thank you, Ila, for this timely paper, and thank you, Shekhar, for organizing this session. So that's the first thing. The second is how we treat savings raises all the cacophony surrounding personal income tax. I think we've seen it, at least I've seen it since the mid-80s when Dr. Chelaya and Dr. Rangarajan did the first report on expenditure tax. VP Singh had set up that group. And then consistently, Chelya Committee, Shom Committee, Kelkar Committee, Y.V. Reddy Committee, Rakesh Mohan Committee, all of them have recommended a particular method of taxation. Government of the days have attempted to move one step forward and 2 steps backward. So today we seem to be in a mess. We don't know how to clean up. Every session that we discuss in our task force, every session this topic comes up, we are more confused as to how to progress. The confusion is not what should be the final contour of the taxation regime for savings, but how do we proceed to that? How do we move to that point? How do we manage the transition? I hope Ila in her papers will deal with some of these issues. Apart from what should be the design, she'll probably help us get some input on how do we proceed to that point. With these words, I'll leave the floor to Ila. Thank you.
Okay, let me just say a couple of words before tossing over to Renuka, who will be presenting the paper. About 3 years ago, there was an RBI committee on taxation of saving instruments, of which I was a member as I was in the Ministry of Finance at that time. The biggest challenge was first to put together a data set of what all the instruments were and what were the different kinds of tax breaks that were being given to these instruments. And believe me, that was the hardest job, because there are so many different kinds of instruments, and the tax treatment has been changing over the years, so it was not clear what was the tax treatment, what were the discounts being given. Of course, once that had been done and it was understood that almost every saving instrument was getting a different tax treatment, the challenge was, as Arbind has said, the challenge was to think about how to make the transition towards something that's more uniform, that doesn't actually just encourage one instrument versus the other. And I think this is still work in progress, and I hope that this paper is of interest in that context. I toss over to Renuka. Renuka, request you to present.
Thank you all for being here, and thank you for that introduction to the paper. And before I start, I must add that the start of this paper actually has also been conversations with Arbind Modi on the issue of taxation and household savings. So thank you for getting us started on this subject as well. So let me just, since we are short of time, let me just, set the context. I think both our chair and Ila have really set the context for why this is an important question. But let me just emphasize that one of the reasons why we really care about savings and financial savings in particular is because it's a key driver of economic growth. You want capital from households to go to the firms, and we've seen many papers which talk about how firms are capital constrained. And while we see that savings in India are very high, we also sort of know that savings in financial assets have been very low. Now, one of the levers that has been used is this tax break, so that it is argued that with the tax break, you will channelize savings into financial assets because people get a tax break. But international literature shows that tax breaks can have one of two effects. One is that they can increase overall savings, but on the other hand, all they might do is there might be a substitution effect between instruments that do get a tax break and instruments that don't get a tax break. International literature, again, sort of has, shows that there is more of a substitution effect, though there are some papers that say the other, but more or less, I would argue that the literature claims that there is a substitution effect. And several policy reports in India, one that Mr. Modi mentioned, have also said that there is only a substitution effect when it comes to financial savings. However, econometric evidence on the substitution effect is weak. It's largely absent. So I think that this is where we fill the gap. we bring together both macro data and micro data on this question of has the tax policy led to an increase in financial savings overall, or has it channeled household savings into specific financial products? And if that is so, what might we be able to say about tax policy going forward? And, to our knowledge, we are the first that can bring together both some macro data and micro data to answer this question. Why does this matter? Like, why is this important? Because you would argue that such few people in India pay taxes, we don't really care. Actually, in the class of people who pay taxes, individual taxpayers are the highest. So while, overall our tax compliance might be very low, but in the class of people who pay taxes, these individuals are the largest share. And of course, if we wanted money to be, or finance to be channeled from households to the market or to firms, then this is the class that we are going to look at. And so how they save is extremely important, and how they get influenced by tax breaks is extremely important to study. And also, several committee reports have talked about the distortions these tax breaks create. So I quote from the the book that Parthasarathi Shom wrote in 2002, where he says that incentives that erode the tax base most are related to savings. Similarly, the last year's economic survey, the 2015-16, also talked about how tax incentives lead to fiscal loss and how it creates distortions. And so it's really important to study this from that perspective, which is why we started on this subject. So perhaps most of you know the tax incentives, but to just give you a brief background, these are the tax brackets in India. So if you earn income less than 2,50,000 rupees, you don't pay tax. Whereas if your income is between 2,50,000 to 5 lakh, you pay a 5% tax. Between 5 and 10 lakh, you pay a 20% tax. And greater than 10 lakh, you pay 30% tax. And for all of these, basically a deduction of 1,50,000 can be obtained through the Section 80C of the Income Tax Act. And those of you who live and work in India, I'm sure you're all familiar with 80C, come Feb, March, and everybody is scrambling towards PPF or insurance or whatever it is. That is the product of choice. So what are the products that qualify under 80C? There is life insurance premium, there is annuity, there is contributions to a provident fund or a superannuation fund, or a equity-linked mutual fund. So these are mutual fund products that are 3-year products called the ELSS, and they have this tax break. Investments in fixed deposits of not less than 5 years. Then some equity shares or debentures, but not all. Some bonds that may be issued by the NABARD at some point. And the Senior Citizen Savings Scheme Rules 2004. So these are the broad instruments that qualify for a tax break, and the most popular ones really are the insurance, the provident fund, and the post office or small savings schemes as we call them, and fixed deposits. So I think that when one thinks of ATC, one is really thinking about these particular products. And if we look at the snapshot of changes on ATC, you see that starting from 2001 to all the way to 2015-16, which is the period that we study, every year something has changed on these tax rules. And every year some break or the other has been given on some instrument or the other. So, there is probably not one year where you could say that no tax break was given. And in 2014-15, the exemption was increased to 1,50,000. So earlier it was 1 lakh, and from 2014-15, the overall limit increased to 1,50,000. So, we can argue that since every year there has been a tax break, if tax breaks matter, then you should see some response in the savings series to these tax breaks, because every year has seen some tax break, and so if there was an overall effect on savings, you should see that financial saving actually increase. And so in the paper we describe in more detail the exact rules and changes related to specific instruments, mainly the fixed deposits, the insurance and the pensions. And before I move on, I'm not going to go into these in detail. On the pensions, the main changes that have happened are on account of the NPS, which is the National Pension Scheme. The NPS was introduced in 2004 for new recruits to civil services. So all government employees who were recruited post January 2004 are now in the NPS. And starting 2009, the NPS was opened up to all the citizens of India. And since then, there have continuously been given tax breaks on the NPS contributions. And in fact, in 2015-16, there was an additional tax break of 50,000 rupees given to the NPS. So when we think of pensions or provident funds, I mean, the instrument that really has been given the tax break is NPS, and I'll come to why this is important towards the end. So, how do we approach this question, right? So I said we look at macro data and micro data, and basically for the macro data, we look at data from the CSO and the RBI. This is the macro series of saving in financial assets that you get from these two sources. We get the GDP series with all its problems, also from the CSO, and financial assets include the following mainly. So there is currency, which is 13%, bank deposits, which is about 44%, shares and debentures is about 3%, so it's a very small part of the financial assets. Claims on government is mostly the small savings schemes, the post office schemes, and that's about 4%, insurance at 17%, and pension and provident funds at 18%. So this is the latest breakup. And it's sort of roughly stayed the same. There have been changes, ups and downs, and I will speak about that later. But broadly, this is the share of financial assets in total assets in the economy. On household data, we basically, had the choice of two data sets. One was the IHDS, which is the household survey that University of Maryland and NCAER have put together. NCAER and University of Maryland have put together. This is a sample of about 41,000 households. It's a panel data which did one wave in 2004-05 and one wave in 2011-12. And basically, as far as we understand, they interview households throughout the year and they ask income for the past 12 months. So from a tax perspective, because we wanted to arrive at an annual income to classify households as to whether they qualify or they're eligible for the tax break or not, we had to only focus on households that were asked this question in March, because then we can calculate the annual income and see whether it is taxable or not. And on the savings questions, they ask a flow question, which is over the last 5 years, has anyone in your household invested in one of these following instruments? And so because we could only focus on households in March to get the annual income, we looked at a new household data set, which is the consumer pyramids. This is also a household survey run by the Center for Monitoring Indian Economy. They go to the field thrice every year. It's also a panel data, and they cover approximately 160,000 households. They also ask questions on income, consumption, sources of credit, and savings instrument. And because they go 3 times a year, we are able to get the annual income for the household for the whole year, and which is why we chose to use the CP and not the IHDS. We do checks with the IHDS to see whether our numbers are drastically different, and on many counts they are not, despite the difference in years. And the question in CP that we have focused on is, do you, that is the household, have outstanding investments in one of these products? And as you'll see, many of these products are eligible for the tax break. So households are asked, do you have outstanding investments in these financial products? And if we want to classify a household as a tax-paying household versus a non-tax-paying household, it's possible that your household income is above the threshold, but no single member earns enough to qualify for the tax bracket. So what we did was, CP also gives us individual members' income. And so for every household, we check whether there is at least one member who earns more than 2,50,000 or 5 lakh or 10 lakh, to classify them as a tax-paying household. So if there is even one member who earns a particular, above the threshold, then it's a tax-paying household. If there is not even one member, then it's not a tax-paying household, despite the fact that the annual household income may be beyond the threshold, because then there is nobody in the household who's actually paying tax. As I said, CMI goes into the field thrice a year. So we calculate the income for the 12 months from April 2016 to March 2017. And the savings responses are the responses in the first wave of 2017, which is Jan, Feb, March, April. Okay, so those are the answers on outstanding investments that we take. And this is important because when we start thinking of tax, we start worrying about tax compliance and where the income is coming from, how much is agricultural income, etc., etc. And so what we also did was we sort of focused on the occupation, and we divided, we classified the various occupations in CMI into 5 categories. One was own employment, so anyone who was a businessman, self-employed entrepreneur, self-employed professional, small trader, hawker, was classified as own employment. Agricultural laborer or wage laborer were classified as laborers. Anyone who was a worker, employee, support staff, manager was classified as salaried. Then there was organized and small farmer as agriculture. And then there were a bunch of other occupations that get classified as other. And again, this is important because when we think from a tax compliance point of view, we want to focus on the salaried class because we know that they are most likely to pay tax and there is less likelihood of mix-up of, where the income is coming from and whether they are paying, whether compliance is high or low. So coming to the results, if we look at the macro data and we look at household financial assets as percent to GDP, we find that actually they have been following since about 2009-10. And even with the new series, they are, the new and the old series are roughly close to each other. And we find they're about 10% of GDP as of 2016 March. So despite the fact that every year there were tax breaks given, we don't see much of a jump in the overall financial saving series. And these are the total financial assets of households. And again, from as a percent of gross savings, we were at 45, almost 45% in 2001, and we have actually fallen over the years. And if we look at the new series, we are at about 30-31% of gross savings. So here again, we see no evidence of movements between the tax breaks and the macro series. And look, at no point in the paper are we able to make strictly causal estimates about whether one thing causes the other. But if one were to just look at how the series were moving and what changes have occurred in policy, you just see not much of a movement in any of the series. And that sort of tells us that it doesn't look like much is happening when tax breaks are given on overall financial savings. So then what's happening on the composition of financial savings? And again, if we look at the different percentages of financial assets as a percent of total assets, total financial assets, we see that while there has been a tax break given on pension and provident funds every year, the share has risen from 10% to about 18%. So since that was the main instrument of choice when it came to tax breaks over the last few years, you do see a change in the composition of savings. So perhaps there is something going on here. So then we come to the household survey data, and if we look at the household from the CP data on households that are under the tax threshold and above the tax threshold, you see that when it comes to financial assets, insurance, fixed deposits, provident funds, small savings, the proportion of households that say they have outstanding investments in some of these assets is much higher for those households that fall in the tax bracket versus those households that do not fall in the tax brackets. And this is, again, data from CP. And you see how the proportion of households with outstanding investments changes as you increase the tax bracket. And here is just a comparative table from IHDS. Now, just bear in mind that IHDS is a flow variable because they say, did you invest in the last 5 years? Whereas CP, the variable that we have used is a stock variable, which is, do you have outstanding investments in the following assets? And, roughly, it's a similar pattern that the more you are in the tax paying bracket, the more likely or the more larger proportion of people are investing in the products that do get a tax break. Similarly, if you look at household portfolios by occupation, and if you look at the salaried class here, you see that when it comes to insurance and pension and provident funds, we find that the largest proportion or percentage of people who invest in these assets come from the salaried class. And the next one is those who have own employment seem to buy a lot more insurance, whereas on the small savings fronts, it's, the numbers are not as stark. So, coming to some evidence of how the tax breaks are affecting households' investment in particular financial products, we run a probit model where our dependent variable is whether the household has outstanding investments in the 4 products that seem to be the most important, and TI stands for whether the household falls in the tax bracket or not. And we have a variety of other controls like the age of the head of the household, the religion, caste, education, whatever else that we could get from CMI, and the paper gives a description of what are the controls that we have used. So if you see this probit, you find that basically those households that are in the tax bracket are more likely to invest in all of the 4 tax incentivized products. So if you are in the tax bracket, you're more likely, your portfolio is more likely to have these products. And if you looked at the marginal effects, which is the effect of going from not being in the tax bracket to being in the tax bracket, then you see that the probability really increases for the insurance product and the pensions product. So clearly there is something going on here when it comes to the tax break and savings. Of course, you could argue that this is purely an income effect and it has nothing to do with the tax break, because those in the tax bracket are also those who have more income, obviously, and because they have more income, they are now investing in financial assets, and the tax story does not count at all. So we thought that there were 2 ways to test this. One was that we study households in the same income group but different tax exposure. As I had mentioned earlier, we have the household income, but there are many households where no single member earns above the threshold. So while the household income is roughly the same, because there is no single member that does not earn above the threshold, the household does not pay taxes, whereas the other household where there is a single member, at least one member that pays taxes, will be exposed to the tax incentives. Secondly, we also study differences in household characteristics that might matter for purchase. Now, you would argue that if there was some thinking going on behind buying insurance, then certain kinds of household would be more likely to purchase insurance if it had nothing to do with the tax break. So, depending on your age, depending on how many dependents there are in your house, etc., you would be more inclined to purchase insurance, and these differences would show up in the coefficients on the various controls. Whereas if it was the tax break, then you just couldn't care less, right? You're in the tax bracket, no matter what your age is, no matter what your other characteristics are, you go and purchase insurance. And so we see if that is the case. So here is the data for how we look at the households that are under the tax threshold and above the tax threshold, even though they fall in the same category. And we only focus on the salaried class because, as I had mentioned before, it's difficult to figure out in the case of agriculture or any other occupations whether there is compliance or not. So we think that the compliance is highest for the salaried class, and so we focus on these results here. We have results on the other classes and a differentiation between occupations and what the probability changes with occupations, and I'm happy to discuss that outside of this presentation. And so if you look at the outstanding investment of the salaried class across the different categories, you see that, as your income goes up from 300,000 to, let's say, 350, 400,000, the probability of you investing in insurance and pensions really increases. So while you're in the same income category, households that have a tax break or that are supposedly paying tax are more likely to invest in insurance as opposed to households in the same tax bracket but that do not pay tax. And I think that sort of reaffirms the hypothesis that there is perhaps a tax break and a financial saving story going on. And these are the marginal effects, and you see here again that there is a story when it comes to insurance and pension funds. Similarly, like I said, household characteristics and purchase, and if you look at this regression, you find that in the class of taxed households, really no characteristic seems to matter very much. We do have a significant result on income, but as you see, the coefficients are, negligible. So we don't think that there is much of an income effect going on here. Whereas in the class of non-taxed households, there is some differentiation between household characteristics and purchase. So you are more likely to purchase insurance as you get older, but at higher ages, the coefficient sort of turns. Men are more likely to purchase insurance. Similarly, those in the lower caste are less likely to purchase insurance, etc., etc. So similarly, those in urban regions are more likely to purchase insurance. So there is some variation. You see that perhaps there is some thinking going on about who wants to purchase insurance and who doesn't, but the minute you come to the taxed households, really none of these seem to matter. And we think that suggests that perhaps tax incentives are playing a role. And so what do we make of all of this, right? What are the policy implications arising out of it? So one is that we actually do have a low tax base. So while it's true that these people pay a lot of taxes and these are the only people paying taxes and they matter for how savings get channeled, if you start looking at the economy, it's actually a very low tax base. And if overall financial savings don't change, it's perhaps because we are hitting out at actually a very small set of population in India that gets affected by these tax incentives. So this is data from the Consumer Pyramids survey, and you will see that, most of our households are actually in the 0% tax bracket. So 92% of the sample is actually not paying tax. And if I compare it with the IHDS data in 2012, the numbers look roughly similar. So almost 89% of the IHDS sample is also not in the tax paying bracket. 7.6% of the IHDS sample is in the 5% tax paying bracket, as is the Consumer Pyramid sample. So there are a few differences, but more or less we think that both surveys are pointing to the same number, which is that the tax bracket is extremely small. I also mentioned that some of the largest tax breaks have been given to the NPS. However, despite those tax breaks, the treatment of various products is very inconsistent. So if you look at the NPS follows an EET structure, whereas if you look at insurance and other provident funds, they all come under an EEE structure. And, as a result, the incentives are not really uniform. So even in the class of products that do get a tax break, there are many wedges and many distortions. And perhaps this explains why the composition of savings also doesn't change as much as you would expect. So, every year you give a tax break to NPS, and if you look at NPS data from the PFRDA, which also we have looked at, I haven't mentioned it here, you see a rise in the NPS contributions, okay? However, if you look at it from the overall perspective, you see that the jump has been minimal. And perhaps the reason for it is that while you've given tax breaks on one aspect, you haven't really taken away the wedge on the, the withdrawal aspect. And so the EEE and the EET wedge kind of remains, and several committee reports have talked about this. And, we also mentioned this, that you really need a harmonized tax treatment of long-term savings product. And even here, how you classify long-term versus short-term is very odd. So an insurance product that, you're supposedly investing for 10, 15 years is classified as long-term, as is a pensions product, but a 5-year fixed deposit also gets classified as a long-term product. And so one really needs to think about how we are going to classify long-term as well, because that also creates a distortion in how households start thinking about some of these financial products. Also, one thing that our previous works, makes us concerned is the large-scale scandals and mis-selling that we've seen in insurance. And as you've seen from this presentation as well, when it comes to tax breaks, insurance is one of the favored products for just, going and putting your ATC investments in. Even when you looked at households under different tax brackets, the largest results that we saw were for insurance products. And this is a concern because over the last 5-10 years, we have seen huge mis-selling scandals when it comes to insurance. In fact, there is a paper that Monica Harlan, Susan Thomas, and I have where we estimate that mis-selling of ULIPs between 2005 and 10 costed us around USD 28 billion. There are audit studies that have been done by a number of people that show poor sales practices. There is a survey that NCAER actually did some years ago on why people invest in insurance, and tax was one of the big reasons that took people to insurance in the first place. So in such an environment of poor consumer protection, it really, makes us wonder, why is it that we are giving tax breaks on such products? Because tax breaks really matter for how households start investing in financial products. Since I have 3 minutes left, I will now conclude, which is that, so far empirical evidence on the impact of tax breaks has been scant. Part of the reason has been that household survey data was really not available in great detail. So now we have the Consumer Pyramid Survey and the IHDS survey, and both of them together telling us that there seems to be an effect of tax incentives on the composition of household portfolios. There does not seem to be any effect on overall financial savings. And this impact seems to be largest for households in the category of 3,50,000 to 5,00,000. And I think that makes sense, because if your threshold is 1,50,000 is where you're getting an exemption, then those at 3,50,000 are really the ones that are going to benefit the most out of it. And our work tells us that we really ought to rethink what policy goals are being served by giving these tax breaks, considering that there is an inconsistent tax treatment, considering that long term is not clearly defined, and that these tax incentives really make a difference to those households in the tax bracket, and the skewed composition of portfolios that we see in India. Thank you.
Thank you, Renuka. More particularly, you've only validated what we always thought about the impact of tax incentives on savings. I wish the discussants at some stage could throw some light on how do we proceed from here. Because at the end of the day, what gets if the findings don't get translated into actual policy, then they just remain theoretical papers and don't help much in terms of designing the new tax law. So I would now request Dr. Rao to throw in his, Mr. Mehra, if you could start. Okay, thank you.
Thank you, Shekhar. Time flies. 15 years ago, I was here discussing Ila's paper also, the first session. So, and over the years, I've done that so many times that I asked her that if she wants for a change of discussant, she has the right to do that. Thanks again. This is a really nice paper. I enjoyed reading it. And it's a contribution to the literature on taxation and savings. There's a huge literature there. The paper doesn't mention that. I will allude to some of it in the next couple of slides. So historically, savings for retirement was never a major public policy issue, especially in developing countries, as life expectancy and the working span largely coincided. But over the last 20, 25 years, increases in life expectancy have increased the number of years households spend in retirement relative to working years. And so this issue of how to motivate time-consistent saving for retirement has become a major public policy issue. And one of the instruments that governments use to induce households to save more is tax incentivized saving schemes. So the question is, do these incentives increase household savings, or they simply result in portfolio rebalancing? Well, let's look at it. How do tax incentivized schemes work? and essentially, they work by increasing the rate of return to a particular asset class. The after-tax rate of return goes up, and it changes the price of future consumption relative to current consumption. So this induces both an income effect and a substitution effect. Making future consumption cheaper induces households to save more. However, tax-free compounding increases the after-tax rate of return on assets, and this in general will lead to portfolio rebalancing for sure, and may induce households to actually save less. Because you're doing intertemporal consumption smoothing, and you get a higher rate of return. So I could save less to get the same amount of consumption in the future. So this is, it's a fairly well-known result that this would depend on the elasticity of intertemporal substitution. Let me just show it in a very simple model in a minute. So you look at a two-period model. In the first period, agents work, consume, and save, and in the second period, they just consume their savings. And if you work this thing out, you can easily show and here R is the after-tax rate of return. I didn't want to gunk up the slides with lots of tax rates and things like that. But you can see it's completely ambiguous. So theory doesn't tell you up front. And this is a partial equilibrium analysis, and one would have to, and I'll allude to it if I have any more time, that you have to see how the government will balance its budget. So if you're giving a subsidy here, will Ricardian equivalence hold, et cetera. But it's ambiguous. All right. I'm not going to spend too much time on this thing because Renuka already did this. But the key thing here is that, actually I did a calculation this morning, it's less than 0.5% of the working age population in India, okay? And so the key point to take away here is any quantitative effects of policy changes here are likely to be insignificant. And that's, they acknowledge that in section 6. So we're playing with very tiny numbers. In their actual survey, 92% fall into zero. So there's going to be no effect there of this thing. 7.6 are below the 5% range. So you're basically looking at 1%. So this is like arguing that I went from 1 to 2 and I had a 100% increase. I mean, so one has to look at quantitative magnitudes as well as to put it in perspective. Okay, so the first thing is that they give you this picture, and again, Renuka spent a lot of time explaining this. I don't think this is the right way to look at it. And the reason I don't think this is the right way to look at it is that this ratio is going to go up because of inflows, but will also change because of a revaluation of existing assets, because of stock market fluctuations, as well as changes in the macroeconomy. And the key here is the thing, all assets must be held before and after the announcement of the tax break. So this will lead to revaluation. Once you announce a tax break, there will be portfolio shuffling and there will be a reevaluation of assets. So you're confounding the two things. So what we did here, I'm going to show you plots which do not look at stocks but look at flows. So I was very lucky to get Saurabh Bandyopadhyay here to get these plots done. So this is the sum of all inflows into financial assets as a share of GDP over time. And you can see it is up. This is normalized with GDP. So this is different from the plot in the paper. So you can see that this is the period of their study. It goes up from about 6% to 12%. That's almost a doubling of flows into, and these are annual flows, so they're not subject. And if you want to take out equity, which is more volatile, you get a similar picture. And so, I mean, from these plots, at least it's clear to me that inflows as a share have increased over time. In contrast to the paper's conclusion, I view this as consistent with increase in inflows to financial instruments over the period of the study. And needless to say, this does not imply causality or anything. I mean, that's another thing in the paper is it's all about correlations, but some of the conclusions they drive, I think, are too strong, and it smacks of causality. Okay. All right, now the micro perspective. So then the authors next estimate the effect of being in a taxable income bracket on the probability of having investments in specific financial products. And since I have 3 minutes to go, I'm not going to repeat what was done that was shown. But here is the key thing. I mean, I found table 6 to be the most interesting. So this number 0.06 means that implies that moving from a non-tax paying bracket to a tax paying bracket, the probability of investing in fixed deposit increases by 6.5% and similarly. Table 5 just shows statistical significance. I had a hard time to see what those numbers meant other than these numbers are statistically significant. Okay, but there's a problem here. There exists potential for co-founders in the empirical analysis. Some potential co-founders in the paper would include income, wealth, financial literacy. So for example, wealthy people pay both taxes and invest more. So this mechanically will induce a correlation between paying taxes and investing. And the authors are aware of this, and they are, and in an effort to mitigate this, they exploit the differential taxation in income match households. So they look at households which are matched by income, and some are tax paying and some are non-tax paying. So they are completely aware of this problem. Again, may I get 1 more minute?
Yeah, sure.
Okay, good. Then I'll. So basically, now they characterize salary household based on salary, and they change X from being an indicator variable to one representing category values and rerun the probit regressions. Now, when you go from non-tax paying to tax paying, which is tables 5 and 6, the comparison is between households with tax paying. The results are strongly statistically significant. It's right there. But then when you go do this more nuanced analysis, where the comparison is between salaries tax paying and non-tax paying in different salary brackets, the statistical significance largely vanishes. In fact, it's only in 2 income brackets, and that also for insurance and one other product there. So that goes away. So given this mixed evidence, it would be premature to conclude, and their words, that there exists a tax incentive effect to investments in financial products. So the conclusions seem to be rather strong based on the evidence. Now there are other these things. So given that the findings of the paper, one implication is that are these subsidies being given? Are they regressive? Are they being given to the already wealthy people who don't need it? So that's something one may want to discuss. How does the government balance its budget? In the little toy example I showed you, I didn't have any intertemporal budget of the government there, but that's key. And then the other thing is credibility of government policy, and that has always been an issue in India. For instance, if you look at dividend policy, it goes yo-yoing every, so often. So you really don't have a credible commitment. And finally, I think it's a venture into a relatively new and topical area of public policy research. It's very interesting. This is a work in progress, and I look forward to a more nuanced parsing of the implications for tax policy. And thank you. I think I made it.
2 minutes late. Thank you for your incisive comments, Dr. Mehra. Now I turn to Dr. Rao for his comments and views.
Over there, or?
Anyway,
I think
you can start from here also if you want.
Thank you. Let me at the outset thank Shekhar for calling me just 4 days ago and telling me that I should perform this duty of commenting on this paper. I'm not too sure whether I'm a 12th man, but that doesn't matter. But that doesn't matter. This is an important paper by Pandey, Patnaik, and Sané on a scantily researched area. There is very little except an old paper by Ronnie Dasgupta way back in the early 90s. when we were all talking about the tax reform for the Chelaya committee, where he did calculate the after-tax rates of return on variety of, on these various financial instruments.
Dilip was also associated.
Yeah. So, except that, I mean, there isn't much in this. So, in that sense, I just a welcome addition to the empirical analysis. In India, while the tax policy is employed to pursue multiple objectives, in fact, there are several objectives that the tax policy is made to pursue. There are very few studies analyzing their cost and efficacy in achieving these objectives. So in that sense, it is opportune, particularly because Arvind Modi is busy redrafting, not just redrafting the tax law, because the first direct taxes code was drafted by him, which possibly gathered dust.
Didn't see the light of the day, so I don't wonder what will happen to the second one.
Then there was a second one which again went into this thing. Now this is the third one which is being sort of attempted, and hopefully something will happen. Now, I just want a bit of a clarification that, the tax incentive that is given is not just for, so increasing savings. There are three different objectives of this policy. One is increasing, sort of basically superannuation, encouraging people to save for their retirement. The second thing is, to risk factor of life insurance. And the third is basically to transfer the physical, basically to encourage people to have more of physical, financial savings as against physical savings. So in that sense of the term, looking at things only from sort of a superannuation perspective is not really appropriate. That's one of the things that I wanted to say. I mean, of course, the paper doesn't do that, but, the paper examines whether the tax breaks given to promote financial savings have been effective. Expectantly, the study concludes that the tax breaks have not led to higher financial savings. And using the CMI Consumer Pyramids Household Database, the study shows that while the tax-paying households invest more in tax-exempt financial savings, financial products, it has been basically done by substituting other financial products. This has very important implications for policy, and as it raises the question as to whether the tax breaks for promoting savings should continue at all. In fact, in the first direct taxes code, there was all this attempt to remove all these, sort of these things. So possibly, Mr. Modi will revert to that in his report. Now, a priori, there is a bit of a trickiness in the way in which, particularly in the, the saving incentive given to the fixed deposits, the marginal gain from tax benefit becomes zero after saving 1.5 lakh, 150,000 rupees, for the new entrance to income tax bracket. But in fact, for the existing taxpayers, if you have saved for 5 years, you can continue to avail the benefit without saving any new saving. Because you can simply roll over. In fact, you have saved it for 5 years, simply roll over what you have done 5 years ago, and it doesn't really, you don't really need to save additionally in order to gain, get the tax benefit. In that sense, the entire, the whole relationship between tax, benefit that you get and savings is, very, very different. The deductible savings has only a 5-year locking period, and then after that you can simply renew that. While there may not be any dispute over the overall conclusions drawn from the study, in my view, the analysis needs to be strengthened. They say that it is a work in progress, possibly they will strengthen it more. The major conclusion that there is no relationship between tax breaks and financial saving may well be true. However, this cannot be merely inferred from the lack of correlation. We need a more robust analysis of determinants of household saving, increase in investment by households on physical as against financial assets may be simply because of higher after-tax rate of return, on physical assets, because you see, you don't know what the after-tax rate of return on physical assets. You're only looking at some of these instruments, and then of course the lesser, after-tax rate of return will not only, on a property, land or a immovable property, depends on the rental income plus the capital appreciation. So we need more robust. So increase in investment by households on physical as against the financial asset may simply be because of higher after-tax rates of return and lesser volatility of the former. The after-tax rates of return on various physical and financial assets may vary due to a variety of factors, including the relative inflation rate, volatility in prices and returns, and the state of physical and financial markets. So if the financial markets, there is a lot of volatility if there is a global crisis and if there is a very high rate of inflation, possibly people would prefer to save more in physical assets rather than in financial assets. So the tax may not be a factor there at all. The trend in household sector investment portfolio shows an increasing pattern over time. The composition of bank deposits has shown sharp reduction from 58% of the total listing to 43.6% in your table. Now, so there has been a sharp reduction in the households, sort of investment in bank deposits. But at the same time, you see that the share of provident and pension funds has shown a sharp increase from 10 to 18.3%. Now, why is it so? Why is it that the bank deposit share has declined and pension and financial, pension funds, this thing? Is there a reason for that? I mean, is it because of the NPS, or is it, what exactly? Why has it actually happened? Because this is the compositional shift is very substantial. The authors could garner possible explanation for this sharp change in composition of financial savings. Is it the high after-tax rate of return, or is it due to the introduction of NPS? In fact, pension funds have a longer lock-in period, unlike in the case of fixed deposits. The lock-in period for the pension funds is much longer, yet have shown a steady increase over the 4-year period that you have shown. Authors have used consumer pyramid household data to separate out taxed and non-taxed households. I think this is a bit dicey. The criteria for determining the households as taxed households is, at least one member of the family having in excess of the threshold. Now, could this have been due to agricultural income? Is it possible that, in other words, can we really say that just because they have more than, sort of 2.5 lakhs of, one member has more than 2.5 lakhs of income, is it possible that he may be an agricultural, it may be agricultural income and then he may be exempt. So one has to be a little more, possibly find a little more better method of doing this. The profit regression estimates, the coefficients of fixed deposit are consistently lower than those of the other financial assets, if you have seen. One possible explanation is that only a small proportion of the fixed deposit constitute tax saving part. People, save for a variety of reasons, not just for saving taxes. And in particularly in the case of fixed deposit, that may be the case. In other words, the tax saving part of small saving is very small, is a very small proportion of the total fixed deposits. A predominant proportion of the fixed deposit is in a period lower than 5 years, actually. It's not in the more than 5 years. Possibly one can see how, in terms of the time profile of the fixed deposit itself, whether we can do some, infer something. There are some minor errors in the paper. Okay. Now you start by saying that household sector financial saving is 7.8%. Of GDP, and then, but as you go along, your analysis says that it is 11% of GDP. Now, you have to be clear whether it is 7.8 or 11. You say that there are 39 million people pay tax, and you call it 1% of population. 39 people do not constitute 1% of population. They constitute more than 3% of population. I mean, it may be quibbling, but then I think this type of errors should be avoided. On the whole, this is an important and interesting paper, and I hope this is the beginning of a much more incisive analysis to come. Thank you.
Thank you. Thank you, Dr. Rao. Now would Renuka or Ila like to respond before we throw it open for some questions from the floor?
Rajnish, it's always a pleasure to have you as a discussant because you add so much to the paper. That's why for the last 15 years, every time I have an IPF paper, I want you as a discussant, and Shekhar, please in the future also, please. Rajnish and Dr. Rao, thank you very much for your insights. The paper is clearly work in progress. When we began this study, we had requested Arbind Modi to let us have the actual anonymized data of taxpayers, and we are hoping that one day when India has that policy, we will also be able to get that data and maybe study this question more more precisely in greater depth, because at the moment we are just looking at household surveys which don't really answer this question. We'll certainly be looking at some of these issues. One of the things that we have not addressed, and I'm surprised that nobody raised it, is also the question of tax foregone. Because after all, when the government gives these tax incentives, they do forego taxes on saving instruments. And one of the reasons why neither the harmonization has happened, nor have we moved much on this, is the fact that if that were to happen, then perhaps the tax foregone is greater. In the first direct tax committee code that Arbind had authored, I would say basically the idea was that we need to move all instruments towards a similar tax treatment, which is exempt tax, so that at the end, when a withdrawal is made, at some point, at some point income is taxed, and it seems that the best one was exempt, and then at the end of it you tax. But a lot of these instruments, such as provident fund and insurance products, remain exempt. So there is this clear question of introducing distortions. I mean, that is a distortion that has actually been introduced. So it's not surprising, and I would say that part of what we've not been able to capture too well, because we don't have that detailed data, is that it is not surprising that people prefer exempt to the extent they can. I mean, it's very intuitive. I'm sure if Rajnish had been able to give us comments before we actually wrote the paper, he would have made us put in a model and say, now you have to address this question. So with that, I would welcome more comments. This is clearly work in progress, and all your comments are very, very welcome. Thank you.
Thank you, Ila. Any questions from the floor or comments? I'll be happy to take.
Yeah. Thanks, Ila, Renuka. That was I think it's an interesting reflection for us in IPF as you think about the importance of the question relative to how much data there is. And so I know it can be frustrating taking on something so important without the data. So thank you for doing it, because I think we know the data limitations. So just two quick comments. I think one is connecting to. I think most of the results are on the intensive margin of the volume of savings, and I wonder if it would be possible to also look at the extensive margin on the likelihood of using formal financial savings instruments. So connecting to an IPF paper from 2 years ago by Tarun Ramadurai and Memal Balasubramaniam, that looking at the distribution of assets, like I think the median household has zero financial savings. So I think there is obviously the literature that looks at the role of tax savings in overall volume of savings, but I think thinking about it also in terms of the number of savers and thinking about the incidence, and therefore where in the distribution one might want to target any tax incentive, I think would be very useful. And then I think a related point goes to something I think Rajnish also mentioned, which is indirectly what Ila was talking about, the tax revenue foregone. So I just think about this in terms of regressivity. So I think my sense is that a lot of these programs are quite regressive to the extent that even if you get some marginal benefits, I mean, it's for the most part a lump sum transfer to people who would have already saved. And so, I think when we do a full analysis of the opportunity costs of those tax expenditures, thinking about how you might use that same revenue to also get the objectives in the first margin. So for example, if you have all these Jan Dhan accounts that for the most part are inactive or don't have much money in it, are there instruments that one can think about that would allow us to crowd in savings on the extensive margin, and just reduce the regressivity of these things as well. So just adding more work to do.
Any other? Yeah.
The whole point of the IPF conference was to improve papers, and so I appreciate the spirit in which Ila has acknowledged what the formal discussants have made. Ila, Govinda sort of touched on this, but I think the paper would be enriched with a discussion of the motivation for focus on financial assets, which has been moving. And I think Rajnish has located it in terms of, as it were, the retirement problem, which of course was the framework that is well known from developed countries. I do think we should note that that is a big evolution from where this basically started, which was resource mobilization. The notion that essentially financial resources would then be funneled through the banking system to government projects. I don't know whether that shift in focus is important, but I think hearing now that this is a contribution to a very thin literature, I think providing the whys and wherefores for focusing on financial savings would be important. So that's at the kind of macro level. Then there's the issue at the micro level, which is, does greater fungibility across financial assets actually improve the welfare status of the household itself as compared to the lumpiness of saving in physical assets? Now, in prehistory, at the time of Tobin, where there was a lot of, there was a literature on portfolio shuffling of households in rich countries. I mean, the econometrics of this, as I recall, was constrained by, I keep losing the mic, but constrained by the fact that there is an overall net worth constraint, okay? So the question of whether there's wealth data that you could use, or you could at least, this is very irritating, and what that wealth constraint consists of, and whether, most importantly, gold should be a part of the wealth constraint as seen from the household. And here, it's not clear to me that it's only the subset of taxpayers you want to look for. So I think the notion of the overall portfolio allocation problem that faces Indian households, how they consider their wealth, whether we have any information on how capital gains, as Rajnish had mentioned, enters into this, whether it is therefore a change in, as it were, the flows are changes in target stocks. I think all of this would enrich the paper. Thank you, Jim.
Thanks. Dr. Desai, please.
Yes, thank you. I really appreciate the topic and the paper. I think it's terrific. Eli, I was particularly happy to hear you talk about tax return data at the very end, because that is the answer to this kind of a study. And in particular, in your next request, what's been powerful in the US has been heavy oversampling of high-income households, because you cannot study these phenomena without really looking deeply at high-income households. So I think that's terrific. Second, and this is just to amplify Govind and maybe Suman's comments, which is, it seems like one of the primary effects is on the structure of financial intermediation, which is just to say, the fixed deposits are going down, pension plans are going up. It seems like the first order story in that substitution is about effects on intermediation. In the US, we think it's my brokerage account. going into my brokerage account that's a retirement account. Here, we're talking about, I think, something quite different. If it's just fixed deposits that are also being held inside the retirement plan, then there isn't. But if there is real changes in intermediation, that's interesting. Third thing is just, on this strategy of the households with different, the tax thresholds, I don't think it's dicey. I think it's quite nice. But you'd want to do more to show that the households on other observable characteristics are similar. So I think it's a very nice strategy. It just might be worth clarifying that it's the right strategy. And then finally, I was just curious about phase-outs. So the way we think about this problem, usually in the US, is with phase-outs, which is we limit revenue loss by phasing out the subsidy or phasing out the advantage to high-income individuals. So my sense is the phase-out here is just it's a one-off cutoff at a level for the savings amount. But I would have guessed that phase-outs by income would be a much smarter way to think about this in limiting revenue loss and limiting substitutability, because it's more likely to be the 100 lakh person who is going to be substituting than it is the 10 lakh person. So I'm just curious if that kind of phase-outs exists, or why the way we limit it is on the amount as opposed to phasing out by income level.
You, please.
Two comments, and these are really for the chair, which builds on earlier comments. Very clearly, this analysis is better done using administrative data. And I would like you to share with us, why is it that the tax department would neither do the analysis itself nor allow anyone else to do it? Why is it that the government sits on so much data, it does not have the capabilities to analyze it, and does not even want to allow others to analyze it, even though these are central to understanding the problems it itself would like to address? Second point, which would be interesting to understand, is on insurance. To what extent is the fact that the government has a huge stake in LIC drive the way it thinks about insurance tax breaks?
Can you come back? I'm sorry, I couldn't get the second question.
On the insurance products tax breaks, the fact is the government has a big stake in LIC. So it has a clear conflict of interest on this. And the clout of LIC, the government's stake in LIC, to what extent does that play a role in these policies on insurance?
Okay, thank you. Yeah, Poonam Gupta, please.
A couple of observations really. So taking on what Rajnish said in terms of confounders, I think one obvious one is inflation, to the extent that it's a tax on financial savings. I think that if you control for that, your results may change in not just the magnitude, but the direction as well. And controlling for returns, market returns. Market returns would be endogenous to the policy changes we are talking about here. So besides that, something I noticed in one of your earlier slides is that the holdings of cash increased, it seems, quite distinctly in around 2015-16. And if I'm not wrong, that was one of the reasons behind this great demonetization exercise. So are you able to see an impact of that policy change in terms of the behavior of households into financial savings?
Two clarifications here. So the moment you talk about national savings here, so do you think there is a need to study the saving basket of people who are not in the tax bracket, like agricultural households and the zero tax bracket? And second is, have you thought of doing non-linear estimation here? Because let's say if there is any, let's say 1% tax reduction, so the potential money available for saving would be different for each tax bracket, right? So do you think, non-linear tax regression would be better fit? Yeah, thank you.
Yeah, Dr. Chadda, please. Last.
Yeah. It's just a clarificatory question. When we are talking of the impact of tax breaks on household and financial savings, Would, Ila, there would be a difference between households which report they are above the tax limit and hence we are trying to analyze them versus households who could have paid taxes because they have higher income and are still saving in provident funds, you know, because I understand the provident fund is, you can go and deposit in cash, particularly in PPF. So would there be some, I don't know whether it has been analyzed, but households who report that their income is above tax level and households who are likely to be in the tax level but are not reporting. So would there be some difference in the financial behavior or analysis that it would make?
Ila, and between the two of you, if you could respond, I mean, Renuka.
Thank you all for the comments. I'll respond to some of the ones on the data and the analysis. So Karthik's point, very well taken, that the extensive margin is a very interesting question. However, in CP, they don't give us the rupee value of the savings. So we just know whether somebody has outstanding investments in a particular product or not. So if we are looking at CP, then we cannot really answer questions on by how much did that question change. In the IHTS, we do have some rupee value on savings, and so we'll sort of add that. But these are different panels, but nevertheless, it'll be interesting to see what that quantum is. But because we were focused largely on the CP data, we sort of stayed away from that particular question. And, also going to these questions on whether holdings of cash increased or whether, a particular policy had an effect or not, what you really need is continuous panel data on the continuous variables, right? And we are sort of short of that kind of panel data, and so we've had to stick to the data that we have. And, that was the effort for this particular paper. On the comment that Rajnish made on revaluation of assets, we did worry about shares because shares are the ones that fluctuate in market value, and we've sort of drawn the same graphs without, excluding shares, and we see a very similar pattern because shares are only 3% of the total financial assets. And we'll look carefully at your flows data and see, where you are getting those differences from. So thank you very much for that particular comment. On the question of the LIC and insurance, I think that I must address this because it speaks to the previous work we've done on mis-selling and insurance, and I would agree that that is perhaps one reason why one cannot get insurance out. In fact, in the last tax breaks, you had now LTCG introduced for mutual funds, but not for ULIPs. And that again speaks to the wedge in tax policies, because in many ways they are very similar products, but now they are taxed differently.
Anybody else? Ila?
Again, thank you very much for the comments. We are going to try and address those that have those suggestions for analysis, but let me just respond to a couple of comments. I thought Suman's point, which Rajnish had also made, is very, very important, that the policy, the reason for the tax breaks has perhaps, without even stating it very clearly, moved from being trying to invest, trying to encourage financial savings in financial instruments, to thinking about now the, thinking about retirement savings and to thinking about pensions because of the changing age profile of the population. And that's something that we have not addressed. I'm not sure how we will address this, but I think that's a very, very important point here. And perhaps that's something that Arbind is spending time thinking about in the DTC, that, it also links to the question of we don't have a big pool of long-term savings in the country. So even beyond the question of financial savings, it also goes into where do we get savings for infrastructure for example. For investments in infrastructure, we've seen how banks have got into trouble because, banks had short-term money while they were lending long-term. So that links to the bigger macro questions of of encouraging savings for retirement, as well as thinking about long-term savings for investment, particularly in projects like infrastructure projects. On the phase-out and data and insurance, I'll leave those questions to Arbind to answer. He's better placed to answer those questions. Thanks.
I think I'll first respond to the specific question from the floor on why doesn't the tax administration issue release data. Well, this is a regular problem. We've been contending with it since ever I started working on tax policy in a limited way. Initially, it was that we didn't have the data. But now, in the last decade or so, we've actually built up a large volume of data. We are still, actually these were all in a very fragmented database, and in fact we were ourselves not in a position to use that data, do data mining and effectively use it against tax evasion. It's only recently that we've launched a new project, Project Insight, which allows us to create a comprehensive database, and once that is rolled out, we are in fact internally exploring how we can share that data in what manner with the outside world. Whether, individual tax data or, some kind of a summary data, etc. But that call has yet not been taken. Hopefully in the next 1 or 2 years, you should see some movement on that. And that would mean that you could do more quality work on tax policy. Second, what would also happen is that much of on sharing of data, there's now a lot of international pressure that the secrecy of the data needs to be maintained, FATCA, etc., etc. So we are also looking at putting in place an appropriate legislation, which will, while ensuring secrecy is maintained, the academia gets the data for doing the research. So that's on the research part. So you can be fairly optimistic about it. Now coming to insurance product and why tax break for I really ever since I joined the department in '81, I know that this incentive was there. In fact, probably the initial incentive was only for life insurance product. Why it came? Probably yes, because as Dr. Berry rightly put it, that initially all these incentives were given, I don't know whether it was actually intended for savings per se, but it was for the government, to enable the government to mobilize more resources, because it's only the discourse changed post mid-90s that it is actually for savings and not for mobilization of So initially we were only extending these benefits to government managed products rather than going out for the privately managed product. First time in '88, '89, around that time, when mutual fund, or for that matter, UTI was the first one to be given. And UTI also was more or less government managed, And then late 80s, when the mutual fund industry actually started making inroad, the first one was SBI, that is when we kind of opened up and we started looking at how do we use tax incentives to deal with savings. And by then, some of these products, there was so much of entrenched interest, vested interest in this, that reform of the savings related tax provisions has become extremely contentious and difficult. Every time we make an effort, in fact the last effort we made at cleaning up was in 2016, and we burnt our fingers then also. We will again make an attempt, knowing fully well the pitfalls of that. In fact, some of my colleague members are worried that our sincere effort may jeopardize the entire report. So whether we should actually, burn our fingers again on this savings issue. But then, well, that call has to be taken. So before I close, thank you, Ila, and thank you, Renuka, thank you, Dr. Rao, thank you, Dr. Mehra, and thank you, everybody else, for participating in this exciting discussion, and also throwing light on some ways how we can move forward. I mean, at least we know where we stand, so hopefully we can design a better tax policy on the savings side. Thank you very much.